You can hear.
I can hear.
Yes.
Yes.
Three. On the phone only.
Okay. Yeah. Okay. Well, in that case, I apologize for a little bit of technical difficulties there. We had a little bit of difficulty getting audio to come up on the screen as well here with Zoom, which is not the typical platform that we use internally. Usually, we're a Google shop only. So, I appreciate everybody bearing with me on this. We had the legal meeting of shareholders at 4 o'clock. This is the informal portion of the meeting where we have an opportunity to talk about the state of the business, the performance last year. I want to go through a couple of things. I was about to talk about ground rules for having folks mute themselves, but after this starts, I think probably I'll avoid that. I think what I'd like to do is let folks know, who we have on the call right now. I think we've got 91 participants, which is the entirety of our board of directors, myself, my dad, Christian Melish, our CFO, who's here, a very good portion of our staff, our counsel from Goodwin Procter, Samantha Kirby, I think I saw join the call, as well as our auditors from Wolf & Company. And additionally, I think probably the largest number of non-director, non-staff shareholders that we've ever had attend before. So I think we have some folks on the call from as far away as Israel and Central America, and certainly as close as Boston or New York or Chicago. So I'd like to thank everyone for joining us. I wish that we were all here in person, as we were talking about earlier, and I think we talked about in the press release for this meeting. The annual meeting for us has been a special time for our company. Certainly since the change of control in 1993, following the proxy fight, and there are a lot of folks who were on this call, both on the board, and Artie Regan, who was in that fight. Artie's raising his hand up there in the corner, who were around at that time and remember that. So it's a special time for us, and it's disappointing that we were unable to host this meeting in person, and we were unable to meet you all. There are a fair number of you that I've met in person or talked to them, but it's not quite the same as hanging out. So with some of those introductions out of the way, what I'd like to do is a couple of things. First, I'd like to walk through the presentation that we made available on our website, and in a couple of minutes I'm going to swap over to presentation mode, and hopefully everybody will be able to see that. And at the conclusion of that, I think we have quite a bit of time for some discussion and some questions. There are some that I received in advance, and I'd like to go through some of those. And then after that, it's my hope that we can just kind of open it up. With 97 folks on the call, I'm not quite sure how we're going to do from a meeting management perspective, so I'd ask everybody's patience and forbearance on that. Okay, so to the business of the bank. I'm going to share my screen and flip over to the presentation. Okay.
I dialed the first one. I dialed that phone number. I used that.
So everybody should have that slide deck up, and we'd start walking through that. Okay, so the safe harbor statement, this is on the presentation. It's on the website. I'm not going to read through the entirety of it. There may be things that we discuss during the call that are forward-looking in nature, and we don't undertake to update any of that. Introductions we've dispensed with, and we can walk right into the nature of the business and the financial results last year, and then to some discussion. Okay, so first, anybody who quotes Warren Buffett at you should immediately be the subject of, I think, some great skepticism. But this quote is just so perfect that I'm willing to take some of that opprobrium because I appreciate it so much. Banking is a very good business unless you do dumb things. So the question in banking, the question for our partners is fundamentally, are we doing dumb things? So what is it that we do, I think? We do three things. We lend on commercial real estate, and this is primarily real estate that people live in. So the bulk of our portfolio is multifamily property, either larger apartment buildings or portfolios of smaller buildings or individual 1 to 4 family investment properties, or in some cases apartment buildings with a retail component, which we describe as mixed use. But the bulk of it is stuff that people live in. 2, residential real estate lending. And we do this entirely for our own account. We don't sell into the secondary market. We don't participate in any government-sponsored programs. And the bulk of that business is relationship business, where we're delivering something that customers have difficulty getting in the much more liquid and efficient conforming market. So that is often self-employed borrowers or borrowers with income situations that are more difficult for a standard conforming lender to underwrite. And then finally, we fund those two businesses in large measure through our personal and commercial deposit businesses. And we'll get into a little bit more detail on what those businesses consist of. So, I don't think that we think that those are dumb things, but there are a lot of things that we don't do for a variety of reasons. And I think that it's equally worthwhile to walk through what we don't do and at least briefly touch on why we don't do it. So the two big categories that we're not involved with, commercial and industrial lending in any of its iterations, and consumer lending. So if it's unsecured, if it moves, if it floats, if it flies, if it fits in your wallet, we're probably not interested. Those are not businesses that we specialize in. They're not businesses that we think we have an ability to deliver differentiated product to our customers. And they're businesses where we don't think that we necessarily have a handle on the risk characteristics for those businesses. Furthermore, we don't have a wealth management business. We don't have a trust department. We don't do any advisory, either internally or in partnership with others. Those can be really excellent businesses. They can be excellent businesses, particularly when they're partnered with banks that operate in some of the demographics that we operate in, but they are not businesses that we know how to run. And consequently, we've stayed out of them. We don't do any insurance brokerage. There are a number of banks here in Massachusetts that are very active in that, namely Eastern. We don't do any secondary market residential mortgage, so we face no counterparties, whether private or public, the GSEs. We are the decision maker on the residential business that we do. We don't do any tax credit lending or purchases of tax credit. It's a level of complexity that is beyond us. We don't lend on solar. And then finally, and I think importantly from our perspective, we don't do commercial mortgage participation. So we don't sell pieces of the business that we do, and we don't buy pieces of other people's business. We insist on evaluating all the transactions we do ourselves, and we insist on doing that for a variety of reasons. One, we want to understand the assets. We want to understand the relationship with the customer. We want to be in a position to extend them flexibility if it makes sense, and we want to be in a position to drive the bus if that deal goes sideways. So having said what we do and what we don't do, what do we do with all the capital that we generate? And I think this is also something that's important and probably not often discussed enough. There are some things that we think are attractive. These are not listed in exact order of priority, but they should give you a sense of our business. First, we have never acquired another bank. So in the now 27 years since the change of control, all of the growth has been organic. And our strong preference is to deploy the capital that we generate, the incremental capital that we generate in those businesses. So in the lending businesses that we understand, in our core deposit businesses. And that can be thought of in a couple of different dimensions. One, the business; two, the geography. Historically, that has been Boston alone, and more recently, Washington, and we can get into that in a little bit more detail. And two, the dividend has been an important part of our capital allocation strategy for a long time. It comes in two parts: a regular dividend and a special dividend. The regular dividend can best be thought of as what's sometimes referred to as a Ulysses contract, or a contract that binds us in the future. And I think that keeps us honest about our ability to deploy the capital that we retain. Special dividend is more of an escape valve for capital that builds in the balance sheet. Three, we're unusual in that we make minority passive equity investments, generally in financial services. Again, we can get into a little bit more detail on that later, but those are instances where we think that we can partner with outstanding management teams. We can pay prices that don't reflect control premia, and we can benefit from businesses that we don't have the capacity to build internally. Finally, we have never repurchased shares, although it is something that we've discussed and would be open to. I'd say that our focus with respect to repurchase would be value creation, and we would be very sensitive to price. I don't think we have an interest in a monotonic repurchase or repurchase to offset, what is frankly not very substantial dilution from equity compensation in the first place. What's not attractive: control acquisitions. We've never done them. Generally, we think the prices are too high. We think there's a tremendous risk that a company would lose focus. And finally, we think that generally cost synergies are elusive in those transactions.
Can you ask people to mute their phones again? There's a lot of background noise. I'm getting those from everyone.
Yeah. If I could ask everybody who's on the call just to mute yourself, whether you're on video or if you're on phone. I'm hearing that there's some folks complaining about background noise. So 2019, we'll get into the meat of it. 2019 was, I think, a very good year, although there were some unique tailwinds that we were benefiting from that we'll touch on in a minute. In terms of earnings, we made just shy of $39 million. A significant component of the increase in 2019 was adjustments to the fair value of our equity securities, which performed from a market perspective very well last year. But the core returns on equity were, again, really strong. The 16.82% reflects the fully loaded number, the $39 million. Adjusted for the securities gains last year, my memory is that number was in the low 14s, I think 1430 or 1435, which again is, I think, adequate. I think we would like to do better. We have done better in the past. There's a particular challenge in the last, let's say, 12 to 24 months with respect to margin compression because of the liability structure of our balance sheet. And some of those challenges have have begun to abate. Shareholder equity, book value per share, is a very important metric for us. We talk about this quite a bit in every one of our earnings releases, and every year look back at the 5-year compound annual growth rate. We ended the year just shy of $116, a 5-year CAGR of just over 15%. And that is obviously exclusive of the capital that we were returning to the owners in the form of dividends. Low-cost leadership. This is something that is important to us from a financial perspective. It's important to us culturally, and it's something that differentiates us from others, and we think is a source of strength in difficult times, like I think everyone is facing now. Last year, the efficiency ratio was, I'm disappointed to say, slightly higher than in 2018. In 2018, we had breached 30% for the first time. We're slightly above 30 last year. There are a variety of things driving that number. This is often the subject of questions that we get, and I just highlight that the efficiency ratio is the product of two things. First, what we call structural choices. Those are choices about what businesses to be in and not be in. And then second, operational choices. So having decided that we're going to be in commercial real estate lending or in residential real estate lending, how do we run those businesses efficiently so that we can create margin for ourselves that we can use to aggressively seek out what we think are the highest quality credits, pay a little bit more on deposits for relationships that we think are substantial and could be long lasting, and to find and recruit and to retain some of the best people to keep that business going. So it's important to think about the efficiency ratio in both those dimensions. The lending business. So last year, we ended, again, just shy of $2.25 billion. It was, I think, another strong year for loan growth. The 5-year compound annual growth rate of just shy of 13% has been very consistent for a number of years. I think that reflects our focus on trying to identify high-quality credits which are available in all markets. In particular, the commercial portfolio, we had very strong growth last year, and this reflects quite a bit of growth both here in the Boston market and in Washington. Growth is great in lending, except when it's not. The sort of first rule of banking is to try to avoid losing money in a levered business, particularly if you're levered 10 or 11 times to 1, as most banks are. Mistakes in underwriting in pursuit of growth can have some really significant consequences. So what we're looking at here, net charge-off since 1997. I'm sorry, I'm going to pause for a second. I'm going to force mute everything here. And we're going to go back. Okay. So, avoid loan losses. So what we're looking at is a record of net charge-offs since 1997. And I think what you can see here is that we've been very focused for a long time on trying not to lose money. You can see in some of the early years, those net charge-offs were actually net recoveries, which was a product of resolving some of the losses that had occurred prior to the change of control in 1993. The Great Recession, starting in 2008, and continuing through to 2012 was something that we were certainly not immune to. If we were to look at delinquencies through that period, there were certainly loans that paid late or encountered some difficulty. But we've always been focused for a long time on maintaining a very low loan-to-value ratio on the transactions that we do relative to our competitors, and structuring our transactions in ways that protect us. So I think this is an important thing for us culturally. It's an important thing for folks to take note of. The deposit business. This is a business that we have historically not been, frankly, as strong at, and has been a business that we've been focused on making investments in recent years. Historically, the bank was, I think as many savings banks were, focused more on time deposits, and that's been something that we've put quite a bit of work into trying to change that mix. Growth over the last 5-year period, compound annual growth of almost 11%, obviously not quite as fast as the loans. That difference is funded by our borrowings at the Federal Home Loan Bank. We ended 2019 at a little over $1.8 billion. A decent piece of this was the product of our use of wholesale deposits towards the end of 2019, as those became more attractive relative to the Home Loan Bank. Over the course of this year, that started to unwind a little bit. I think it's worth talking a little bit about our approach to the deposit business because it also is a little bit different, and it is, if not counterintuitive, then certainly not consistent with what are some general understandings about how the deposit business can be profitable for banks. So first, personalized service. Everyone talks about personalized service. It is in some ways table stakes, but in competing against larger money center banks, it is something that can differentiate. And we've been doing some things, particularly in our specialized deposit group, to take advantage of that. Second, digital excellence. It is unlikely that we are going to deploy tools with the best UI and UX. It is unlikely that we are going to be able to compete with some of the largest banks in terms of some of the edge offerings. But there are ways that we think it's possible to compete on the table stakes products and do so at very reasonable cost. And we actually think that the current environment makes that more possible than at any point in the past because of the democratization of developer resources and networking and compute storage and the drop in costs for those things. Finally, we don't have a meaningful deposit fee business. We collect interchange revenue. We have some limited NSF revenue or insufficient funds on checks. But by and large, our fee income from our deposit business is de minimis. It is almost certainly the lowest in Massachusetts as a percentage of the income statement. And as of a few years ago, when we looked at it on an absolute basis, it was extraordinarily low. We may not have been the lowest, but we're close. Two engines for growth here. First, Specialized Deposit Group. Specialized Deposit Group is a team that we have here at our main office. It's focused on our largest, most complex commercial institutional customers, as well as some of our high net worth customers. They're also responsible for digital first acquisition or customers that are opening on our website and not coming to our branches. And then second, our retail banking group, which has offices stretching from Nantucket across the South Shore to Boston, where we have 2 offices. And this is more of a traditional retail branch banking presence. I touched on some of the key things here as I was describing what they do. I think one thing that I'd like to highlight is that as of close of quarter, they're responsible for about $360 million of our retail and business deposits. They had 63% growth in 2019. And if you looked at the presentation from last year, you'd see that they had 63% growth in 2018. That was not a typo or a continuation of that in the presentation. They just knocked it out of the park. There's a significant business development component to what that group is doing. And more recently, they've handled the somewhat limited PPP lending we've been doing for some of our business and nonprofit customers. Looking forward, the Washington project that we've had ongoing for a number of years, I think we're in our third year of lending. We're now in our fourth. The first year that we were very active there was 2017. That's grown to a significant enough piece of the business that we made the decision last year that we wanted to start looking for a permanent home. We found that in February and bought what you can see here is both an unassuming and currently unattractive townhouse in Georgetown, about halfway between M Street and the river for folks who know the area, right by the C&O Canal. We did that using some proceeds from the sale of our former North Scituate location. And we're in the midst of efforts right now with our architects in Washington to renovate this property. And we're hoping that we're going to be up and running here probably in early 2021. We think that the impact of COVID on that process is likely to be more limited than we originally feared. It's moving through some of the municipal authorities with greater speed than we thought. So again, certainly not a palatial building, a small townhouse. This is kind of a sketch of what we're looking to do there. For folks who are familiar with us and have visited some of our offices, although we run at a 30% efficiency ratio, we prefer to own all our buildings, and we take a great deal of pride in them. This is a little bit more modern than we've historically done. You know, our Nantucket property, which is the most recent one that we developed in the summer of 2013, was a building that was built in 1847. Our branch in Norwell, I think, dates 1794. And this building was built in 1910, and the interior that we put in it will certainly be 2020. So with that, I'd like to get to some discussion and some questions. There are some questions that folks had sent in. I'm going to flip this screen off and try and go back to video. I'm going to touch on some of those questions first, and then hopefully we can open this up. So I'm going to try and take some of these in the order that I got them. The first one was from Chris Crawford. Chris, I don't know if you or any of your folks are on the call, but Chris is here in Boston. And
yeah, we're here.
Awesome. Well, Chris is a great investment manager, and that's about the only introduction that I can give for him. Chris' question was around the loan-to-value limit that we have in our securities filings. So we talked about some of the risk limits that we have for originations, whether it's residential or commercial or construction. And Chris was asking, okay, those are the risk limits, those are the top. What does the portfolio itself really look like? And in particular, what do the weighted average loan to values look like for those portfolios? So on the commercial side, we tap out about 75%. That is the formal risk limit for CRE that we originate. We don't go above it. And that's 75% of the lesser of either a third-party appraisal or our own internal estimate of value, which is often lower. That portfolio, the weighted average LTV is approximately 53%. So it's considerably lower than where the risk limit is. On the residential side, it's a little bit more complicated, but generally we don't lend above 80% We will do some lending above 80% with mortgage insurance or for certain specialty affordable housing products. But 80% is the max, and there are some lower limits depending on the nature of the loan and particularly the size of the loan, if it's a jumbo or a super jumbo. And the weighted average LTV for that portfolio is about 52%, give or take. So both very low. The construction portfolio is a little bit harder to answer that question, in part because it's turning over so quickly. The risk limit there is 75% at the max. And generally what we see when the projects have been selling out is that they are selling out significantly in excess of what we are projecting internally. So the numbers on those look like they're in the low 60s based on those sales. Obviously, the current environment is somewhat different. But for the kind of construction we do, which is typically small residential purpose in the city, in the South End, in the Back Bay, in Beacon Hill, in Cambridge, the demand for the end product in the last 2 months has been undiminished in talking to some of the developers that we work with. And we've never done any of what I would call the super luxe product. There's not a lot of it in Boston, but there's some of it, particularly in the Back Bay. And those are folks who are building to numbers well above $2,000 a square foot. And that's been a market that we've avoided. That may be a market that faces some challenges going forward. So I think that covers your question, Chris.
Yeah, very helpful.
Actually, let me ask you, does that cover your question?
It does. That's very helpful. It's encouraging to hear that you've got some very good cushioning, it sounds like, in those limits in the current portfolio.
Yeah, I think as we've talked about before, we have some excellent borrowers with very strong balance sheets and the capacity to suffer, to use Tom Russo's word. But in the end, we are dirt lenders. We're very focused on the collateral that we obtain when we make these loans and the value of that collateral if we ever have to access it. And that's been true for a long time. The next one was from, and Bob, I'm going to apologize because I'm not quite sure how to pronounce your last name, Bob Vanico. Do we have Bob on the phone?
Yes, that's close.
Did I get your last name correct?
Pretty close, yeah. Vanico.
Okay. Vanico? Okay. Well, that's close enough. And Bob's question was, could we walk through an example of a recent loan that we had made on the commercial side to provide a little bit more insight into how we source, evaluate, and structure loans. And I'm going to apologize by answering a different question because I kind of want to touch on each one of those things individually. So I don't have one great example that kind of touches on each one of those pieces. But I think maybe I could take a couple and try and get it what I think is the essence of it. And if I don't get it right, you tell me and we'll keep talking. So in terms of sourcing, most of the business that we do, particularly here in Eastern Massachusetts, is new business to existing customers that we have longstanding relationships with. And that business is really attractive to us for a variety of reasons. First, it's cheap to find. We don't have to advertise for it. The acquisition cost for that customer is extremely low. Second, we have a track record with that customer. So we've got data, whether it's quantitative or qualitative, about how that customer thinks about valuation, how they manage their real estate, whether they are quality operators, what their balance sheet looks like. And that kind of information is invaluable. That allows us to, in thinking about evaluating and structuring that transaction, act much more rapidly. because of what we know about their existing business and our sense for how they think about real estate. That's the majority of what we do. There is another slice or another tranche, which is new business. It generally comes to us through intermediaries. And that might be referrals from existing customers. That might be attorneys, might be accountants, might be brokers. I think as we have grown, we have looked at more transactions that are coming through brokers, in part because those borrowers are also looking to access either insurance company funding or potentially the agencies. And generally speaking, in the markets that we're operating in, those brokers are acting as correspondents for the insurers. So to get access to that funding, they have to go through those sources. Those can be, I think, from our perspective, very attractive sources of business. I would say that unlike the first category, those are often borrowers that we know less about, and the transactions are presented to us in a way that requires, I think, us to exercise a greater degree of skepticism and caution. We do quite a bit of it. Some of those transactions, I think, are very attractive. They're at leverage points that are very low and that we're pretty comfortable with. But for that kind of sourcing, evaluation and structuring can be a little bit different. And then finally, there's a small pool, which is folks that reach out to us directly and not through an intermediary. And that's a pretty small piece of the business. Generally speaking, it's a word-of-mouth referral. It's an existing customer. It's something more formal. In terms of evaluating and structuring, our process is a little bit different. No one here has any lending authority. So my dad doesn't have any lending authority. I don't have any lending authority. None of our lenders have any lending authority. And that is from $0 up to the legal lending limit. All of that authority is vested in the executive committee of our board of directors, which is half of our board. And the folks on that committee have very substantial equity investments here in the company that are longstanding and quite a bit of skin in the game here. And our view for a long time has been that that is a really important risk mitigant in terms of thinking about how we lend and where we feel comfortable from a leverage perspective. I think that kind of goes to evaluation structure. There are not a lot of things that differ between lenders in commercial real estate with respect to structure. I would say there are a couple of things that we do that are probably somewhat different. First, we will almost always trade rate for lower leverage. So we're a little bit like an insurer culturally in that way. We would always prefer to be in at a lower leverage point. And because of the efficiency ratio, we have the capacity to target those transactions and price them a little bit more like an insurer than a bank. I think the second thing that's probably unusual is that we don't have some of the covenants that you might find in other bank structures, particularly around either revaluation or debt service, because we like to underwrite transactions that we refer to as submarine transactions, where if you're 100 feet below the surface, whether the wave action is 6 feet or 10 feet off the surface isn't going to materially impact the economics for us. And then finally, we have some unusual default provisions. So our default interest is probably, we think that it motivates borrowers that are in difficulty to meet their contractual obligations. And when we have situations like that, we may be unusually forceful and act with an unusual degree of alacrity in pursuing those. So I don't have a neat example that would let me bind all that stuff up, but I'm hoping that was kind of the gist of what you were looking for.
Yes, very helpful. Thanks.
Is that a Red Sox hat, Rob?
Sorry, no, it's a Chicago Bears hat. Sorry.
No. Okay, well, you're not the only person on this call from Chicago, so I'm gonna avoid saying anything.
Okay.
I think next, Adam delivered 4 for me here. I'm going to try and touch on these pretty quickly, and then we can open it up to folks who didn't email ahead. So first, could we review the investments and changes that we made in the IT systems or applications in the last year? And this year, unlike I think last year, there were some changes that were less visible on the surface. One major change that we made in the last year was in June of 2019, we combined our debit processing. So the vendor that does the back-end processing for all of our issued debit cards for our 10,000 plus checking accounts. That had previously been a company called Elan, which was owned by US Bank. Elan was purchased by Fiserv, which is our core provider, which means that they provide the sort of base ledger for all of our businesses, as well as the online banking services for our retail and business customers. And when they did that, although we had the option to stay with Elan, we made the choice to integrate those systems, which was an investment more of time than of money. And had some, I think, some real advantages from a back office perspective in terms of efficiency, and has allowed us to do some things on the customer perspective, on the customer side, that customers value. It's not certainly something that changed the business. It was an incremental improvement, but the ability of customers to turn their debit cards on and off, to set alerts, to have some of that card management built into our mobile app was, I think, something of some value. And we didn't need to spend much money on that. There have been some things that we've been doing on the business side, in particular, in terms of positive pay for some of our commercial customers, some of the sort of incremental improvements to the cash management suite that we have that have been of some value there. And then there have been some things that we've done internally that are not, again, groundbreaking, but have allowed us in the margin to work a little bit more efficiently. So the use of some new project management tools, particularly Asana, has allowed us to do some of our work internally, I think, a little bit more efficiently. The real juicy question, though, is Adam's second question, which is, how do we plan to invest in those internal or external systems going forward? I think that it's probably known to a lot of folks on the call that most community banks use core systems and then ancillary systems from one of 3 primary providers, Fiserv, which we utilize, Jack Henry, and FIS. There are a couple of smaller core providers. So there's a firm called COCI up here in the Northeast. There is a firm called CSI, which provides similar services, mostly to smaller banks. But there's an oligopoly for these products, and the companies are, in a number of ways, great businesses. They have been, I think, great partners to banks for a long time in terms of providing reliable services. I think that it would be fair to say that there is a relatively high degree of displeasure amongst many of their clients with respect to both the reliability of service that they deliver and the capacity of those firms to innovate. And some of them are doing a good job, and some of them aren't. These are big companies. It's hard to turn those ships quickly. So our primary contract is coming up in a couple of years, and I think that that's a topic that we spend a lot of time discussing internally, i.e., will there be options for us that are sufficiently mature that we could look to transition at least some portion of what we're doing, whether it's in the core or it's in the ancillary surrounds the customer sees, to some different providers. But I think one thing that is certain is that there's a greater degree of competition, particularly in the ancillary services, than there was 15 years ago, 10 years ago, or even 5 years ago when we renegotiated this current contract. And I think that that competition is probably going to be to our benefit, and that competition is driven by one of those things that I mentioned earlier, which is 30 years ago to roll out a bank core system, that required a lot of CapEx, that required on-site IT. If you wanted disaster recovery, you needed to take that investment and probably multiply it by 2 or 2.5 to account for some of the management overhead. And now all of the resources that go into deploying that kind of capability, to building it, deploying it, are far cheaper, and they're accessible to a lot more people, which means that the competitive options for us as the intermediate client are, I think, a lot more attractive. I'm going to skip one and then get to the sort of meatier one. Adam also asked, we talk in the Q1 release about future real estate sale proceeds being reinvested in new property. And he asked whether we plan to expand further in DC or in Boston. And that specific reference, we purchased the property in Georgetown in February. We paid a little over $1.1 million for it. We sold our North Scituate property roughly the same time, and we sold that for my memory is $350,000 or $360,000. And to the extent that there was a gain, we did that I think actually after the Georgetown purchase. So we took that and moved it through that reverse 1031 entity. Our South Weymouth property, our former South Weymouth branch, we closed in January, and we've been actively marketing that for sale. So to the extent that we can sell that within our 1031 window, within the reverse window, we're going to take the gain from that sale and reverse it back into the Georgetown transaction. So that wasn't meant to imply that we're looking at purchasing any more real estate either in Washington or in DC. And then the last of Adam's 4 questions, which he sent me 10 minutes before this meeting, so he's going to pay for that. The equities the bank invests in, and we described them generally or more specifically, and then additionally, is there a target allocation, whether as a percentage of shareholder equity or as a percentage of asset? And I think I'd touch on a couple of things here. First, our powers in this respect are unique. They are not exclusive to Massachusetts savings banks, but when you look at banks that have active equity investment portfolios, they tend to be here in Massachusetts because of the unusual nature of the charter. So having said that, our approach to investing in equities is guided by a couple of things. It was sort of born of our evaluation of the economics of control acquisition. And our view that control acquisitions are particularly unattractive, and the prices that are paid and are demanded are very high and reflect, as I said before, these control premia and cost synergies that we didn't think we could achieve, and we didn't, I think, have the sense of hubris or arrogance to think that control was really worth that much money. And at the time, when we started this, I think we began in 2013 or 2014, our view was that there were better businesses that were available in public markets that had higher sustainable returns on equity, that had either reinvestment opportunities or capital discipline. And there are some holdings that we have that have some great reinvestment opportunities. There are some holdings that we have that we think exercise good capital discipline. We're really interested in management, particularly in smaller companies that we think is owner-oriented. And then finally, we want to pay a good price. So this is not a methodology that's particularly novel, nor is it unique. There are some companies that I think very similar to that. And as Picasso said, great artists steal, and so we're trying to be in the business of stealing, and some of that is philosophy. So we have the ability to do this and do it on terms that are more attractive than control acquisitions. So if we're going to do it, what are we going to look at? And I think that goes to the focus of what we do, which is primarily financial services. So it's money. It's historically been focused on banks, although we have some really material investments in payments, in ratings, in what I might refer to as financial infrastructure or financial technology. We've tried to be careful about avoiding discussing a lot of the specific holdings, particularly the smaller ones, for a variety of reasons. But some of the larger ones, particularly the payment companies, are I think, no great secret. We've had longstanding investments in Visa and MasterCard in particular. And our view is that those are companies where we can make sense of the economics, we can make sense of the source of the return on equity. And in some of the smaller companies, particularly the banks, we can, I think, have some differentiated perspective on how they run the business and how they lend because of what we do in our core business. So some of what we do in the core business is taken into the investment business. Some of what we learn in the investment business is taken back into the core business. And that's particularly true in some of the businesses that we invest in that are quite small, that are not directly touching on financial services. In terms of a target allocation, we don't have a target allocation. We have some risk limits that we've set, some of which are set by statute, some of which are set by our regulators, and then there are a much lower set of limits that we have internally. So I don't really have a specific number for you, Adam, although I would say that we invest at a level that is derivative of our perspective on the value that we're obtaining when we purchase and elect to hold, as opposed to attempting to remain 15 or 20% invested in equities over time as a percentage of shareholder capital. And we definitely don't have a target allocation with respect to assets. That takes me through, I think, all of the stuff that was submitted in advance, although there's an additional one that I can see in the chat feature here, and I think I touched on some of this before. I'll read it out as it was private. What is the track record on the portfolio of fintech marketable equity investment securities? Did you also pursue this strategy during the 2008-2009 crisis? If not, when did you start? If it was active then, was it in any way different than today in terms of size? And the short answer to the second piece is we were not doing this in 2008 and 2009. So it was not active then. We made these first investments in 2013 and 2014, and that's grown over time. In terms of the track record, we haven't put out numbers publicly, although you can deduce some of the performance by looking at the changes in accumulated other comprehensive income in some of the early years prior to 2017, and then certainly the performance since 2017 through today is reflected in the income statement. I think I would say that although we've been satisfied with our performance, there have been some learning experiences along the way with respect to appropriate concentration, with respect to the kind of mix that we have between banks and some of the other financial services that I've touched on. So it's been a process of evolving and of learning, and I think that that's one of the key objectives behind that for us, is both the financial returns, which are the primary objective, but also looking for ways to learn about how to run our business maybe more efficiently and produce higher returns in the core business. So I think that's all I have on that, which takes us through all of the pre-submitted questions. So for anybody else that has questions, Adam, okay. Could you please help us understand the unique default provisions you alluded to? That would appear to be a meaningful mitigant to no DSCR covenant. So, the default rate on our commercial mortgages is 18%. And generally, we will move to enforce that. The grace period on those loans is 10 days. And on the 11th day, we are on the phone with that borrower looking to understand what's going on. And the 18% default rate is, as we sometimes call it internally, a very hot pan. It is not something that people often touch twice. And consequently, for counterparties that are evaluating whether to pay us or to pay other creditors, how to sequence the obligations that they have, we find that kind of structure provides a significant incentive to borrowers to meet their contractual obligations to us in a timely fashion. So it is a unique provision. It is not a terribly complicated one. I hope that sort of helps you in terms of that. Okay, who else do we got? Silence. Folks can either unmute or they can use the chat feature on the right if they want.
You talked about the commercial portfolio. Could you maybe do a little similar sort of flavor on the way you source and structure and all the rest, the residential portfolio?
Sure. So the residential portfolio is exclusively here in Eastern Massachusetts. We don't do any of that business in Washington. And in part, that's because the consumer compliance overhead with originating residential mortgage is just higher. And so to make that investment in the Washington market thus far has not been something that we thought made sense. So we're talking about Eastern Massachusetts, and then within that market, there are a variety of different ways that business comes to us. A lot of it is sort of similar to the commercial side, although perhaps different in implications. So we have an existing portfolio of customers on the residential side that will come to us again for either a new first home or a second home. We do a decent amount of that business here on the Cape and the Islands. We have deposit portfolios to customers that we don't have residential loan relationships with. That portfolio of customers is probably more affluent than not. It is not a portfolio that looks like First Republic's in aggregate, which is a bank that some folks might be familiar with, but it is a more affluent demographic. So those customers often have needs, particularly some of our small business customers that have income situations, like I said, that are a little bit more unusual and more difficult for the secondary market to underwrite. And then the last bucket, which is a bucket that comes from intermediaries, but it's different than brokerage, is from, in some cases, the construction developers that we work with in the city and South End. In some cases, it's residential brokers that we've maybe done business with commercially. The residential business, in much greater part, is a relationship business that's tied to the other things that we're doing. It's much more unusual that we will do a single transaction in the residential business and not bank you personally or not have worked with you in the past on another home or done some commercial lending. But that's not a business that we advertise for. Our advertising spending is very low. And in part, that's because if we're going to keep that on our balance sheet, we want it to be a relationship where we're going to be able to do something else with you. So that's a little bit different. Okay, Chris, jumping again. What is the long-term plan for the Washington market? What would you like it to look like in 5 to 10 years? I think it's probably helpful, and I don't want to go on at too much length here, but it's probably helpful to understand why we thought Washington was attractive. And for the folks that have heard this before, I apologize because it'll sound so. It's a market that we think, A, has some very attractive, durable features in terms of the underlying economy, the presence of the government, the presence of some of the secondary industries, the presence of the height cap in the district has an impact on supply. So we think it's a market that's likely to be less volatile over time. The data proves that out. We think it's a market that's likely to have quite a bit of product that is stuff that we like, smaller multifamily property, that is a type of asset that we understand how to underwrite, we have some experience with. Those are qualities that make it very different from some other markets that we might have looked to expand into. Washington was a place that a number of us knew personally. Both myself, I had lived there for 10 years before coming to the bank. A number of our directors had long personal experience in Washington. We had a lender who had worked on the buy side investing in real estate for some period of time down there and still had some family. So there are a number of things that kind of came together there. It was a market that was not nearly as competitive as Eastern Massachusetts. So mid-sized banks between 1 and 10 billion in Washington have really disappeared at an incredible clip over the last 10 years and consolidated in a way that's very dissimilar to Boston. That was very attractive to us. So as we look to the next 5 or the next 10 years, I think our expectation is that the fundamental features of the market that made it attractive for us to bet on in the first place are likely to maintain, are likely to still be present. And they may actually intensify in some respects. So we've been lending there for like I said, about 3.5 years now. That portfolio is just shy of 300 million. We did about 60 in the first year, about 60 in the second year, and then quite a bit of business last year. And we think there's quite a bit of business left to be done there on the commercial side. I think if I were looking out 5 or 10 years, I think the difference between what it will look like for us then and today is that it is likely that we'll be bringing all 3 of the businesses to the table in a way that we're not currently. Right now, we're very focused on the lending piece of that business. Our specialized deposit group has followed in really strongly behind that. We've got, I think, some excellent deposit relationships there. But that's an area where having a larger team on the ground, particularly on the deposit side, I think is likely to change the trajectory of our deposits performance. And so I would expect that in 5 to 10 years, it will be a material piece of the business. It will be a larger piece of the business. I don't think it will have a larger physical footprint, or at least not materially so. But we went there originally because we thought that over a long period of time, we could commit a lot of capital to that market. You know, we were not interested in running an experiment that would only allow us to deploy a little bit of capital. And thus far, I think that experiment has been proven out, although we have not been through a full cycle in Washington in the way that we have here. And I think that I'm cognizant of that. I think everyone here is cognizant of that, and we're looking to test that. So I think it'll be a big piece of the business. Okay, next question. What is our approach towards diversification in the portfolio as protection from systemic risk? How well are we diversified today? From Dan Gorfong. I'm not sure if I'm going to interpret this as really the bulk of where our committed capital is, which is our real estate mortgage investments. Now, I think there are some ways in which we are diversified in terms of systemic risk, and there are some ways in which we are not. We have some degree of geographic diversification that's greater now than it used to be. We used to be highly concentrated on the South Shore of Boston. Now we have a little bit more diversification in eastern Massachusetts. We have our investments in Washington. And there is some level of diversity there, particularly from some of the kind of tail risks that you would imagine could apply to a particular limited geographic area. Our asset selection with respect to commercial real estate is fairly concentrated, but we think that it is more resilient because of that concentration, which is to say the multifamily assets that we have preferred for 27 years have themselves more diversified cash flows and a lower level of future capital expenditure than, say, larger retail or office properties where there's a lot of tenant concentration and there's a lot of, I would say, if not unpredictable, then highly volatile potential capital expense to replace those tenants. You know, in a 30-unit apartment building, if somebody leaves, maybe you take the opportunity to put in a new stove, you paint and paper, you might replace the carpet. This is for sort of B+ multi in the city, but you're certainly not providing a tenant improvement package that equals 2 or 3 years worth of rent to bring in a new tenant there, right? So the nature of the assets that we've concentrated in, we think affords us some level of resiliency as compared to some of those other products where I think those cash flows can really turn off in a binary way, as I think we've seen. Kevin Parks. Kevin, glad to have you on the call. Our philosophy on hedging, specifically with respect to interest rate swaps, and then generally, so I'll touch on this in 2 pieces. First, in most community banks, you'll see two forms of interest rate derivatives. You'll see what are referred to as mirror swaps or back-to-back swaps, and those are really executed with particular customers on particular transactions. And those are used to convert fixed rate payments from the borrower into floating rate payments for the bank. And that's something we have never done, although you see it's quite common. There's some non-interest income that's associated with that can be highly volatile depending on transaction flow. Part of the reason why we don't do it is we don't think that we need to for our customers, and we think that the complexity that we would introduce into our process by doing that, particularly after the transaction has closed and we're considering modifying that transaction in conjunction with something else, you know, these loans are not best thought of as things that are put away and we never come back to, particularly for our customers that we have deep relationships with. You know, we're often renegotiating loans as a part of looking at a new piece of business that we might do. And the use of back-to-back swaps can really complicate that process for us. So it's not something that we've done. And then secondly, you'll sometimes see smaller and mid-sized banks use derivatives to adjust the interest rate risk position of their balance sheet at the balance sheet level. And that may be less common actually for smaller banks. I would say that to the extent that we think about our interest rate risk position, whether we're thinking about that in terms of how we price assets or how we structure our liability, that is something that we will usually do by adjusting our funding mix, whether it's at the home loan bank or with some of the other wholesale sources of funds that we have, whether it's brokered CDs or listing services. So that's something we do at the portfolio level rather than at the instrument level with derivatives, and that is different. And part of that goes back to what I was talking about with mirror swaps. We have what we think is a very simple organizational structure and process for doing some of the things that we do. And we are probably allergic, possibly to a fault, to introducing complexity into those processes when we don't think that the offsetting benefits are really, really compelling. You know, I think we try very, very hard to keep it simple in everything that we do. So I'm not seeing any other. Oh, Adam, one more. We touch on how we think about share repurchases and when we might use it instead of the special dividend. Okay, so sort of a couple of pieces of context around this. The first piece of context that I think is important is we do not have a holding company. And because we do not have a holding company, there are and have been historically some specific tax disadvantages for repurchasing common stock. And without getting into a great deal of detail about how those tax consequences work out, I won't put the folks from Wolf who are on this call on the spot. That has been something that has been I think, a barrier to repurchase in the past. Additionally, I would say that generally speaking, we try to avoid commenting on the valuation of our stock in any way. I think I would say that if one were to look historically, when we thought about this in the past, we did not think that repurchases would be possible at prices that would create value for the remaining shareholders, which I think has to be the driving impetus behind share repurchase. It is the only reason to repurchase stock. There are also some operational considerations that make repurchase more difficult than a special dividend. And I think some of that is probably somewhat self-evident in terms of being able to execute repurchases in a way that allowed us to deploy a substantial amount of capital. I think we've always viewed that as being potentially difficult. Having said that, there are some tax advantages behind using repurchases. I think we're cognizant of those as well. We don't have a kind of bright line rule. This is not something that we have ever done in the past. I want to be careful. I don't want to leave anyone with the impression that we're considering doing this very seriously right now. I think it's something that is a tool that we had not considered before. It's a tool that we're considering now, but I want to be cautious about how folks interpret how we refer to that. The tax advantages of repurchase in size at valuations that are attractive relative to special dividends are pretty compelling if they can be done. But it's something that we think about. It's a tool that we have in the toolkit. It's one that we haven't used yet. I would also say that the use of repurchases generally, the base rates in terms of value creation, when you look at most repurchase activity, are not that great. So I think it's probably important for any management team, any board that's thinking about using repurchases as a capital allocation tool to have some humility about what those base rates look like and what value really can be created. Okay, I see that we're about 5:50. I'm going to apologize to everybody. We actually have a meeting of our board of directors that's going to be starting at 6. And although I could keep going, I'd like to make sure that everyone has a chance to at least take a quick break and maybe grab some dinner before we get started with that. So again, I would apologize for some of the technical difficulties that we had at the beginning. I am almost certain that, or at least I'm very hopeful, that we will not need to use anything that we learned here today next year, and we'll have a chance to see some of you in person. And some of you will have a chance to meet some of you. One of the nice things about the annual meeting is not necessarily getting a chance to meet us or vice versa, but some of our shareholders who are our partners here, getting to meet each other. And that's always been something that I've enjoyed seeing in the past. So on behalf of my dad and I, on behalf of the board, thank you for calling in. Thank you for your participation. I'm happy to be your partner. And stay safe is a little bit cliche. So have a nice night, and we'll see you next year.